This conversation is powered by Google Illuminate. Check out illuminate.google.com for more. Welcome to this discussion on Warren Buffett's 1979 Berkshire Hathaway chairman's letter. This letter is known for its insightful commentary on business, investing, and the economic climate. We'll be exploring Buffett's views on accounting practices, investment strategies, and his assessment of various Berkshire Hathaway subsidiaries. Let's start with the letter's opening remarks on accounting. What's the key issue Buffett highlights?
Buffett begins by addressing a change in accounting rules requiring insurance companies to value equity securities at market value rather than the lower of cost or market value. This significantly impacts Berkshire Hathaway's reported net worth due to large unrealized gains in its equity holdings. He also points out the inconsistency created because Blue Chip Stamps, a Berkshire subsidiary, is still required to use the lower of cost or market value method. This creates a situation where identical investments held by different Berkshire entities are reported at different values.
That's a fascinating point about accounting inconsistencies. How does this impact the way Buffett suggests we should measure Berkshire's performance?
Buffett argues that the ratio of operating earnings before securities gains or losses to shareholders' equity, with all securities valued at cost, is the most appropriate measure of a single year's operating performance. He believes that using market value in the denominator can significantly distort the operating performance percentage due to market fluctuations. He prefers a more stable measure that focuses on the underlying business performance.
So he's prioritizing a long-term view over short-term market volatility. How does this philosophy translate to his discussion of long-term results?
For measuring long-term economic performance, Buffett believes it's appropriate to consider realized capital gains and losses and to use market value for equity securities. He acknowledges that capital appreciation is crucial for long-term shareholder returns, even if it creates volatility in yearly results. He highlights the significant compounded annual growth in Berkshire's book value since 1964, emphasizing the role of capital appreciation in overall shareholder returns.
The letter mentions a significant compounded annual growth. What were the key factors contributing to this growth, according to Buffett?
Buffett attributes this growth to several factors: a low level of leverage, no significant issuance or repurchase of shares, and the acquisition and development of various businesses. He notes that many of these acquisitions were made through negotiated purchases from private owners, highlighting the importance of fair and honest dealings.
However, he also cautions against solely focusing on these impressive numbers. What's the crucial observation he makes?
Buffett points out that the 20% compounded annual growth in net worth, while impressive, might not guarantee a successful real investment return due to inflation and taxes. He introduces the concept of an investor's misery index, which considers inflation and taxes to determine the real return on investment. He argues that high inflation can erode the real value of returns, even with high nominal earnings.
This leads to a discussion of the sources of Berkshire's earnings. Can you summarize the key components?
The letter provides a detailed breakdown of Berkshire's earnings from various sources, including insurance underwriting and investment income, textiles, retail stores, See's Candies, and other subsidiaries. It also shows the realized securities gains, which are separated from operating earnings. He provides separate reports from Blue Chip Stamps and Wesco Financial Corporation for a more comprehensive understanding.
The letter delves into the performance of specific subsidiaries. What are some of the key takeaways regarding Berkshire's textile and retail businesses?
Buffett highlights the contrasting performance of these two sectors. Associated Retail Stores, under Ben Rosner's leadership, consistently generates high earnings relative to capital employed, while the textile business produces lower returns due to industry challenges. He uses this contrast to illustrate his preference for investing in good businesses at fair prices rather than poor businesses at bargain prices. He uses the Wambeck Mills acquisition as a cautionary tale.
The insurance business is a significant part of Berkshire. What's Buffett's assessment of the insurance underwriting environment?
Buffett accurately predicted the worsening of the industry's combined underwriting ratio in 1979. He highlights the exceptional performance of National Indemnity Company under Phil Leish's leadership, emphasizing the importance of underwriting discipline and selectively choosing profitable business. He also discusses the performance of other insurance subsidiaries, noting both successes and challenges.
He also discusses the challenges in the reinsurance business. What are his concerns?
Buffett expresses concern about increasing competition and the influx of capital into the reinsurance market, predicting that this could lead to disastrous results for many companies. He notes that the long-term nature of reinsurance contracts can mask problems for years.
The letter also covers insurance investments. What's the key point about Berkshire's equity investments?
Buffett highlights the strong performance of Berkshire's equity investments in 1979, largely due to the success of the underlying companies. He emphasizes the importance of retained earnings and his confidence in the management of these companies to utilize these earnings effectively. He lists the equity investments with a year-end market value exceeding $5 million.
The letter then shifts to a discussion of bond investments. What's Buffett's perspective on long-term bonds?
Buffett expresses strong reservations about long-term fixed interest bonds in an inflationary environment. He criticizes the insurance industry's significant losses in the bond market, partly due to the accounting convention that allows carrying bonds at amortized cost. He argues that the long-term nature of these bonds masked the risks associated with inflation. He contrasts this with the shorter-term nature of auto insurance policies, highlighting the irony of insurers locking into long-term fixed interest rates while avoiding long-term fixed prices for insurance.
What was Berkshire's approach to bond investments and how did it differ from the industry's approach?
Berkshire avoided purchasing long-term bonds, preferring shorter-term issues or convertible bonds. Buffett admits that even this cautious approach was insufficient, and that they made mistakes by not selling long-term bonds when their concerns about inflation became clearer. He emphasizes the importance of being fully aware of the risks and acting decisively, rather than being partially aware and taking insufficient action.
The letter concludes with a discussion of Berkshire's banking subsidiary and future prospects. What are the key points?
Buffett reports on the exceptional performance of Illinois National Bank and Trust Company under Gene Abeg's management. However, he notes the requirement to divest the bank by the end of 1980 due to the Bank Holding Company Act of 1969. He discusses the challenges of complying with this requirement, considering both a spin-off and a potential sale. He acknowledges that replacing the bank's earning power from the sale proceeds will be difficult.
The letter also touches upon financial reporting and Berkshire's shareholder base. What's the significance of this discussion?
Buffett explains Berkshire's unique shareholder base, characterized by low turnover and long-term investors. He justifies the detailed nature of his annual report, emphasizing direct communication with shareholders and transparency. He contrasts this with the lack of narrative in quarterly reports, reflecting the long-term focus of the business.
He uses a restaurant analogy to explain Berkshire's approach to shareholder relations. Can you elaborate on that?
Buffett compares Berkshire's approach to attracting and retaining shareholders to a restaurant attracting customers. He argues that a consistent approach, offering a clear menu and service, is more effective than constantly changing strategies to appeal to different types of investors. He prefers long-term investors who understand and appreciate Berkshire's approach.
The letter concludes with a look at Berkshire's future prospects. What's Buffett's outlook for 1980?
Buffett predicts that operating earnings as a percentage of equity will decline in 1980. He expresses continued confidence in Berkshire's insurance equity investments, anticipating significant growth in underlying earning power over the long term.
He also discusses Berkshire's management structure. What's the key principle guiding this structure?
Buffett highlights the principle of centralized financial decisions at the top, combined with extreme delegation of operating authority to key managers at the individual company level. He acknowledges that this approach can lead to occasional mistakes, but also emphasizes its benefits in terms of cost efficiency and speed of decision-making. He credits this structure with attracting and retaining talented individuals.
The letter is full of insightful observations and predictions. What are some of the most striking predictions or observations that stand out to you?
Several predictions and observations stand out. His accurate prediction of the worsening underwriting ratio in the insurance industry, his concerns about the risks of long-term bonds in an inflationary environment, and his insightful commentary on the investor's misery index. His emphasis on long-term value creation over short-term market fluctuations is also a recurring and striking theme.
The letter is filled with memorable quotes and analogies. Are there any that particularly resonate with you?
Buffett's Investors' Misery Index is a particularly memorable concept, highlighting the impact of inflation and taxes on real investment returns. His restaurant analogy effectively illustrates the importance of consistency in attracting and retaining shareholders, and his cautionary tale of the Wambeck Mills acquisition underscores his preference for investing in good businesses at fair prices.
This has been a fascinating discussion of Warren Buffett's 1979 letter.
Okay.